Okay, folks, welcome to the Contrarian Trader. It is day 4 of the government shutdown, and we're all still alive. Can you believe it? We're all still alive, despite the fact that we have a president of the United States who goes on with John Harwood at CNBC the other day and says that the market should be afraid. Why is that? It's because Barack Obama, what he needs is a crisis. He needs the markets to melt down. So there is nothing more than what a good old Barack wants than a market meltdown. And he just may get it, but I don't think he's going to get it right now. So let's go over, and by the way, welcome to the Contrarian Trader. This is Bob Desmond. Let's go over the stocks we're looking to go over. I'm going to go over some charts as well of why good old Barack may just get his wish after all. Let's plan on going over DXD. That's going to be the ultra short ETF for the Dow Jones Industrial Average. The XLU, that's the utilities. The VIX IWM, that's the ETF for the Russell 2000 long. The TSLA, that's the 3 times leveraged ETF short of the Russell 2000, and Tesla, TSLA. So let's get started with a chart of margin debt. And this chart goes back to 1990. And you could see in gray is the S&P 500, and in light blue you have your margin debt. And we saw a peak back in 2000. Then we have another peak back in 2007. And what were those? Those were bubbles, and they were bubbles fueled by margin debt. Now, why is that important? Well, the reason that it's important is that we're back at the 2007 record highs for margin debt. We also have a stock market which is now beginning to top out some. And we have plenty of catalysts for the stock market to head lower. Earnings. We have record earnings, negative pre-announcements. We have Janet Yellen that'll take office in January. We have a government shutdown. Who really cares about that? And then you have the debate over the debt ceiling. Let's eliminate a couple of things. There is no difference between the Republicans and the Democrats except for the conservative side, the Ted Cruz side, who's really trying to keep the Republicans, their feet to the fire. They don't want to fight with Obama. They just want everything to go along properly. They don't even care about getting rid of Obamacare. So you need guys like Ted Cruz in there fighting for the American people. Now, does that mean that we're going to default on our debt come the 15th or 17th, whatever it is? No, we're not going to default on our debt. That's insanity. There's no way that we're going to do that. However, what concerns me with this market is that when you had the September meeting of the Federal Reserve, you had everyone, with the exception of Peter Schiff and myself, saying, there's not going to be a taper. We can't afford to taper. The economy is too weak. If anything, they may just have to increase buying of bonds, meaning the Federal Reserve may have to increase buying of bonds. Fast forward to the announcement, there was no taper. And what did everyone come to conclude? Everybody came to conclude, everybody on CNBC, all the talking heads, all of them that were wrong, they all once again, herd mentality, decided, you know what? Good old Uncle Ben, what he's waiting for is to make sure those bad politicians don't shut down the government, don't default on our debt, or else he's going to be there on the sidelines. Now, I'll ask you this. We know the debt ceiling, that's going to get raised. We also know the debt ceiling is going to be raised as well. There is no crisis. It's all made up. It's all political theater. Even the people that aren't working for the federal government right now, with the signs in Washington saying we want to go back to work, as if they really ever worked to begin with, well, they're going to get all back pay. They're not losing any money. So what's going to happen at the next FOMC meeting when Ben Bernanke doesn't taper again? People are going to have to begin to say, what the hell is wrong with this economy? And they're also going to have to ask, if the economy is that bad that Ben Bernanke can't taper by $5 billion for fear of sending the stock market into a bear market, well then, did QE3 fail? Of course it failed, but he can't admit it. So we're being lied to about inflation. He's saying that we stand ready to fight inflation, except they exclude food and energy. I can go on about this all day long. Let's get to the charts. Let me tell you what I'm talking about. All right, weekly chart of the Dow Jones Industrial Average. I remember back in 2007, 2008, you saw a similar chart. Head and shoulder setup on the Dow Jones Industrial Average. Left shoulder, head, right shoulder. Take a look at your RSI in a downtrend. Volume is the only saving grace on a weekly basis. Volume has been relatively light to the downside. What people are doing right now is they're beginning to rotate out of stocks. You could see that more illustrated on the Russell 2000, but they're beginning to rotate out quietly. Institutions don't want to dump all at once and have huge spike volume bars like you saw back in 2011, right here. How else do we know that the market's beginning to weaken? Take a look at your ultimate oscillator, really beginning to drop off. You're seeing a potential double top at the 50 level. Stoch RSI, downtrend. Stochastics, downtrend. MACD, negative downtrend. Williams percentage R, downtrend. If we break down below 14,551, it's all over. We're going down to 13,000 on the Dow Jones Industrial Average. Ralph Acampora, a couple of weeks ago, said that by the end of, this is a bold call by Ralph, and I happen to like Ralph. A bold call by Ralph. He said that on CNBC, the Dow Jones Industrial Average will correct by 2,000 points by December 31st. Whether or not that's true or not, I'm not sure. But you know what? Ralph is a pretty smart guy. As a matter of fact, at that time, he said that the transports would rally to new highs but wouldn't hold. Ralph was right. So you know what? I'll tip my hat to Ralph. I respect him. Perhaps he is right. We could see a big drop in the Dow Jones Industrial Average. And let's face it, all the catalysts are there. I think earnings season, that's what is going to be the trigger point. And the Federal Reserve, when they don't taper the next time around, brother, look out below, because people are going to have to ask the question, why are we buying bonds if it's not working, if it's not helping the economy? Let's move on. DXD, this is the ultra short Dow ETF. It's what you short of the Dow Jones Industrial Average. I traded this back in 2007, made a fortune trading it into the financial crisis. Now here we are, and we're beginning to see some stabilization. Note that the 50-period moving average is beginning to flatten out. Volume spiked higher last week. We're seeing the indicators begin to show signs of life. I'm going to go into this in much further detail with members on the week ahead commentary, which brings me to this. Don't go to my website too. I get a lot of emails. Well, how can your website's not working? How do I subscribe? The site is being overhauled. Brand new website. The pages aren't even secure yet. Not that there's anything to see. You can't sign up using the website. You got to email me, robert@thecontrariantrader.com, and I'll send you out an email link to PayPal, and I'll put you in at the price of the old price, which is $29.95. You get discounts for annual and quarterly. The prices are going up. The prices you see on the site right now, those are the new prices. I had to raise prices due to costs going up. So again, sign up now. Take advantage of the old prices. Let me continue. All right, the XLU. It's the canary in the coal mine for the 10-year yield. Why is that? Why am I watching it? It's because I'm watching the 10-year yield. I think that even if Ben Bernanke does nothing, I think that the 10-year yield heads higher because all credibility with the Federal Reserve is being lost. I think that the foreign buyers of our bonds are getting fed up with our complete carelessness and how little we pay for our debt. Watch the 10-year yield. Check out the XLU. If yields were heading lower, the XLU would be heading higher because the interest rate sensitive. Looks like we're going to have a 50-day moving average crossing below the 200-day moving average. We're pretty much right there. It's only a few days away. We're right at the bottom of an uptrend channel. I think we break. We head lower. Watch the 10-year yield. The housing sector. Ben Bernanke, right? He didn't taper, so that should be good for the housing sector. No? Take a look at the HGX, the housing sector, since Ben announced no taper. We've declined. Here's the peak at May at 210. Here's the trough at 164 back in August. This is a daily chart. We're heading back down to those lows. This economy is broken. QE3 is not working. If QE3 were working, you'd see the housing sector rallying. Mortgage banks are laying off employees because they can't write any more mortgages. Because the economy is so weak, 10-year yield on a monthly basis, the economy is so weak that it can't absorb a rise higher in the 10-year yield to not even normalized basis. We're still below the normalized basis on the 10-year yield, and people can't afford to buy a house. There are no jobs. You have students who just graduate college that are hundreds of thousands of dollars in debt. They can't afford to buy a house. They can't get a job. That's how bad this economy is. But the Fed will lie. They'll continue to use bad data out of the Bureau of Labor and Statistics saying that unemployment continues to drop. It's a falsehood. That is false data. You got to look at the U6 number. Unemployment is well above 10% in this country. Check it out, the U6 employment data, Bureau of Labor and Statistics. The VIX spiking higher on a daily basis. Here's your pivot point, 2191. We break out above 2191, the S&P 500 would be in free fall. IWM, weekly chart. We are topping out. This is 3 consecutive weeks of the IWM churning. Note the topping tail. Churning means every time you have a buyer of IWM, you have a seller come in, institutions, slowly but surely, taking their money out of the stock market. Note the topping tails. That doesn't mean you can't get a spike higher on short covering. It's certainly possible. I call those hope rallies. I don't think we're going to go considerably higher from here, despite this volume. We've had 3 consecutive weeks of above average volume, yet we've made no headway, no new highs, closing highs. That tells you that there's churning out there. So we're looking to add to our short positions on the IWM using the TSLA. The TSLA on a daily chart, looking sharp, stochastics rising, beginning to break out. We were looking to add to this. I'll be sending out alerts to members whenever we make a trade. Price action a little bit stagnant, consolidating. However, Stokes are looking good. Down volume on Friday was light. Really you want to pay attention to the IWM volume because TSLA is more of a trading vehicle. You can't rely upon that volume. I'll be going over that with members on the week ahead commentary. Folks, I send out video commentary in detail using weekly, daily, intraday charts, plus we discuss the short interest on the markets. I send that out to members only. You need to be a member. Take advantage of the old rate. Email me, robert@thecontrariantrader.com, and I'll send you out the link to become a member. Last stock up is Tesla. We are short of Tesla. We have a profit in it. We're looking to add to our position. I'll be going over our strategy. Don't go shorting Tesla on Monday morning. You will get burned. Lots of shorts in this stock. They're amateur shorts, and they will burn you. You need to have a strategy before you add to your position. Keep an eye on my week ahead commentary for how we trade Tesla moving forward. Have a great trading week, folks. Remember, be careful with this market. Email me, robert@thecontrariantrader.com. I'll send you out a link. You can join, and we'll get that website up probably next week. And rates go up, folks. But please take advantage of the old rates now. Talk to you soon. Bye-bye.